So when it comes to investing, a lot of people lose money not because they chose bad investments, but because of what they do after investing. The unfortunate truth is doing less is often the smart move. Hello everyone, my name is Modupe, and today we'll be taking a cautionary look at some common pitfalls that people face when they invest in the stock market. Now, you made what is probably the hardest decision that most people face when it comes to investing. You selected what to invest in, pushed the button and invested. Congratulations. Today, we're not going to undo all that. We're just going to put guardrails in place to make sure that you do not fall into any of the common pitfalls that most people do. When it comes to investing, a lot of people lose money not because they chose bad investments, but because of what they do after investing. One thing about investing and wealth is that a lot of it comes from patience, not necessarily a lot of activity. Sometimes you just need to take the right steps, act once, and let time do its part. Quick reminder, everything we cover is for education only. It's not financial advice. If you do need personalized financial advice, make sure you consult a licensed professional. Something you need to say to yourself, I'm an investor, I'm not a trader. Because an investor doesn't check the market every day. He doesn't try to follow up on every financial news headline or react to every headline and try and time the market. You might have heard this saying before, that time in the market beats timing the market. What they're trying to say is that leaving your investments, giving it time to compound in the market over the long run, does a lot better than trying to figure out the perfect time to buy or to sell. So if you look at the difference in mindset, a trader is usually thinking, what should I buy and when should I buy it? An investor is thinking, what should I buy and why should I buy it? Because once you know why you are buying what you're buying, the time doesn't matter. Even when selecting individual stocks, it's not about buying it before there's an announcement or after there's an announcement. No, it's about knowing that this company will be around for decades to come. Therefore, it doesn't matter if I buy it now or I buy it in 5 years or I bought it 5 years ago, the trend for this company will be up. Now, in this case, we're looking at ETFs, and we know that the global ETF will be around for decades to come, unless there's an entire structural collapse of the total global stock market. Individual ETFs, for some countries, the value may go up, the value may come down, but the global ETF will be around for decades to come. So you can buy it and close your eyes and forget about it. If you're trying to do ETFs for a sector like tech, then you're not sure if tech companies will still be reigning in another 5 or 10 years. If you're trying to do sectors like semiconductors or defense, they may be growing today, but the question is, will they still be as relevant in 15 years? But the global ETF will always be relevant. There's nothing worse than buying an ETF and then the next day you check the price and it has gone down. It happens almost all the time. A lot of people experience it. They buy something and then they check, it goes down. Almost always happens like that. The truth is, no one buys at the perfect time. No one sells at the perfect time either. There's always a better time to have bought, but the next best time is always now. So that was the first thing to avoid, trying to time the market. The second pitfall to avoid is tracking your portfolio or your prices of stocks every day. Now, this one seems harmless because you're just looking at it. But the problem is when you're watching your portfolio every day, you create unnecessary anxiety. And you start to tempt yourself to do something about the portfolio. You start to look at all the other 800 ETFs on the Invest Engine platform and you're like, why am I not buying this one? This one looks interesting. You start to read about them. And then you start to complicate a nicely, globally diversified portfolio with additions from here and there. But the challenge with that is you mess up your diversification ratios, your splits across countries and so on. And there's no guarantee that it will perform better in a 10-year period. It may perform better in 2 years, 3 years. You see it, oh, well, yeah, I bought semiconductors. But 10 years, it's anybody's guess. So checking it every day basically just, it doesn't give your portfolio additional value. It basically just triggers unnecessary anxiety and the temptation to do something about it. And then the third pitfall, and this one is the worst one, is panic buying or panic selling due to some news or current affairs event. So The last time there was a market crash, I was getting comments under my YouTube videos and questions from friends like, oh, what should we do now? My answer to that is, you have two options. You either do nothing or you buy more. But a market crash is not the time to sell. But then the instinct is, let me get out before the price goes further down. My question is, get out and use that money to do what? Because if you do not need your investments, like we said the other time, the price of your assets is only crystallized when you buy or when you sell. If you are just looking at your portfolio on your phone, that's not the real price of your portfolio. It's not the real value. It's the potential value of your portfolio. So that potential value can go up, it can come down, but until you sell it, the value is not crystallized. It's not made real, right? So if you feel, oh, I've lost money, no, you haven't really lost money. You haven't lost money until you sell. It's when you sell that you actually lose money. So if there's a market crash and you see the prices drop and the value of your portfolio reducing, it's only on the phone or on the system. Your portfolio is still your portfolio. If you wait long enough, the prices will go back up again, the value will go back up again. So selling in a panic because prices have dropped and you don't want it to drop further is the worst thing you can do. That's also why you have your backup emergency funds. If you do need cash in that moment, then take it from your emergency funds. Try and avoid a situation where you're actually selling when you've lost, quote unquote, when you've lost money, because that only crystallizes those losses. But then there's also FOMO, where prices are going up and you're like, let me buy. Nvidia is going up, let me quickly buy before it goes up. The problem is by the time you are finding out about Nvidia, is a bit late. By the time you are finding out that Nvidia has gained X% in this number of months, everybody else has also found out, and the market tends to correct for those kind of scenarios. So usually by the time you're making that decision based off the news, it's the same news everybody had, unless there's a gap in information. So what typically happens is when people are joining that bandwagon at the tail end, they are buying when the price has already gone up. They end up buying something that is already overpriced instead of just going with the market average. And then the last one is over trading. Now, depending on which platform you pick, the problem is every trade has its costs. Even on platforms where they don't charge you, because of the spread, you might still be making a loss because you're trading too frequently. You're buying, you're selling, you're buying, you're selling. And then you also have things like the FX cost as well on a platform like Trading 212. The unfortunate truth is doing less is often the smart move. If you're on a platform where they charge you for trading, every time you trade, then you're losing a lot of money doing that. So not only does your investment have to make as much as all the other platforms, then you also have to make up for the cost of the fees, the trading, for you to really justify how much you're putting there. The solution is simple. You have a monthly plan. You have your growth buckets within your budget. You know exactly how much you can and should put into both savings and investing on a monthly basis. You've automated your savings, you've automated your investments. The money is buying a globally diversified ETF every month. You don't need to do anything more than that. You don't even need to check it that frequently. Just set and forget it. There's a simple principle that you can apply. If nothing about your life, your income, or your time horizon has changed, then there's no need to change your investment strategy. If you're going through life changes, you may review it. If your income has dropped or increased, then of course you need to adjust accordingly because you are investing in percentages. If your time horizon has changed, let's say initially you wanted to invest for 10 years, but now you know you're going to need that money in 3 years, then you might need to make adjustments. But if none of these three things has changed, then there's no need for you to touch your portfolio. You have a plan, stick to it. So what we're going to do today is make it easier for you to avoid these pitfalls. So do the following. 1, decide on how often you want to check your portfolio. Just make a decision. It shouldn't be spontaneous. It should be intentional. Is it going to be quarterly? Is it going to be yearly? Is it going to be half yearly? Then add a calendar entry to your phone to say portfolio review, which will be something you will do maybe on a Saturday morning every quarter. You look at your portfolio, do that on a regular basis, but do it based off a calendar entry. Don't do it because you got a notification on your phone, which takes me to the next thing you should do. Uninstall investing apps from your phone. You don't have Trading 212 app and all these apps. Why? When you want to take action on your portfolio, do it on their website. Go to a computer, type it in, put a little bit of friction between yourself and accessing your portfolio so that you're not tempted to nudge it every day. And then the last thing, write this thing down. I'm an investor, not a trader. That's it. So your automatic investment is running and you reduce your temptation to check it every time. When it comes to investing, what you don't do can often be as important as what you actually do. It's interesting that Warren Buffett's number one rule to his managers is don't lose money. Not make more money, it's don't lose money. Rule number 2 is remember rule number 1, which is don't lose money. And that's the greatest investor that has lived in a very long time. Because your investment outcomes are often determined by how much you keep than how much you make. If you're constantly losing money to fees or to taxes or to inflation, then it's going to be difficult for you to achieve your long-term financial goals. If you have any questions, leave them in the comments below. Thanks for joining us today, and we'll catch up tomorrow.